Here are 3 REITs that I am buying for all of this rate cut news that has been happening. Now, for those of you that don't know, we're supposed to see the first rate cut of a few in just a couple of days. It's supposed to be September 17 or 18. Now, when these rates are cut, it really helps REITs be able to expand and make more money because they usually have to accrue large amounts of debt in order to expand and buy other properties to thus make money. Now, with these cuts happening, the amount of debt they're able to use is going to go up, and the amount they're going to pay to borrow this debt is going to go down, making more money for the REIT and more money for the investors through the dividends. One really important thing about these REITs is they are all undervalued for sure. We have seen all REITs, the entire sector, be undervalued because of how high these rates have been. So with these cuts happening, I can expect a lot of these REITs to do really well price appreciation wise, and that's on top of the dividend yield that they pay. Now, some of these yields might be a little bit lower, but tagged with the price appreciation, I have great hope for all 3 of these REITs. I own one of them, I purchased one of them recently, and the third I'm looking to buy anytime now. So if you guys are interested, don't forget to like and subscribe. Check out the channel. I do all sorts of stuff, including weekly dividend ETF commentary. So check that out. Let me know what you guys think, and let's jump right into these 3 amazing REITs. Our first REIT is a very, very strong one at WP Carey, ticker WPC, traded on the New York Stock Exchange. I'm not going to go too far in depth into these ones, guys, because I don't want the video to be 40 minutes long. If you want individual videos where I do a deep dive into these funds, let me know, and I will happily do that. We can see WP Carey is up in the lifetime, up just 200%. Not a great return, but with the dividends, I promise it gets much, much better. Now, this one has come down a little bit recently. If we check the last 5 years, it's down 25%. And there were a few things that happened. 1, the pandemic, and 2, this one did a spin-off. So it owns industrial, retail, a number of different styles of properties, and they had a lot of office properties as well. And so what they did to avoid a crazy crash coming from owning too many office properties as people are continuing to telework post-pandemic is they did a spinoff. And the spinoff they sold, they didn't sell. They transferred their office properties to a different REIT. And what they had to do by doing that is cut the dividend. Now, dividend investors are so strict when it comes to cutting the dividend. And so when you cut a dividend, a lot of people sell. And so that is what happened. And so it has sold off. It has sold off quite a bit. Even from the peak post-pandemic, it's still down 24%, which is definitely not great. So the reason why I'm buying this, I think it has some good bounce back potential. I think selling all of the office properties or doing the spinoff was a good idea. Personally, I'm not buying any office REITs. I think office properties are about to, I think they're going to continue to downtrend with teleworking. And I think when people realize how much money you can actually save, and when businesses realize how much you can save, I think it will continue to spiral. So I think this was a safer bet. And even with having to cut the dividend and irritating a lot of investors, I do think it was a good idea. So let's jump into their website and hit the key points on what this fund is and how they operate. So WP Carey, they have a really beautiful website. They have just under 1,300 net lease properties, square feet, 170 million square feet, which is crazy, and annualized base rent of $1.3 billion. Now, some key things when we're looking at REITs is the occupancy rate, how many of their facilities are paying, not only paying, but how many have people in them, have businesses in them, and that's 89.8, which is pretty good, above the average for REITs, which is, I think, about 94%. 346 tenants and rent escalations in 99.6% of their properties, which is a lot. So 0.4% are not increasing the rent. And we don't know if that's going to be a long-term thing, if that's just current. They haven't escalated the rent, but still a pretty decent number. Going down, we can see geographically, they're not super diverse, but they're in the US and Europe, which to me is enough. I own a lot of REITs that are just in the US because I understand our markets a little bit better and I'm up to date on news, whereas a lot of REITs that have stuff all over the world, it's harder to keep up with all the news and different conflicts going on. So property types, like I said, they sold off their office properties. So they have industrial, they have other, they have retail, and they have warehouses. All of which are good in my opinion, all of which I think can be fine in a recession. Retail might struggle a little bit, but the other ones may make up for it. And then a lot in retail stores with the tenant industry, and then food and beverage, consumer, automotive, grocery, and so on and so forth. You can even come on here and check out their top tenants, which I'm not going to go through all of them. If you guys, some of them I'm not familiar with because they're probably all over the place, like I said, but still, the portfolio map is pretty decent. You can see where they are, but we've already kind of looked over this information. So good. I'm happy about it. Now I want to check out one thing really quickly on their finances. Before jumping into their finances, I want to check all of this out. This is the highlights that they boast about. The size, it's one of the largest owners of net lease real estate. I'm not sure if this is triple net lease, meaning that the tenants do all of the maintenance and upkeep on the properties. I believe that it is, but correct me if I'm wrong in the comments. Meaning if it is, that'd be great. They're not worrying about maintaining the properties. The tenants do that. They're in these properties, so they want them to be functioning well. So that is a really, really important thing. They're diversified. They have a good track record, proactive asset management, and good balance sheet with real estate earnings. I love all of that. Jumping more into the balance sheet, let's check out the next portion. So the balance sheet overview, what I want to talk about here really quickly is this area over here, capitalization percentage. So we can see equity is roughly 60%, senior unsecured notes, which are a little bit riskier than secured notes, 32%, unsecured revolving credit facility term loans, which is 6%, and 3% mortgage debt. Now, so with the equity, in my understanding, this is that they own a good portion of equity in all these companies. In all of these properties. And that makes a huge difference. The more equity you own, the more power you have, the more capital that you have to move around if you need to. And all in all, the less you're paying every single month. If you didn't own any equity in the property, say they're all newer properties. So that is definitely something that I like. I think that's really important to look at when it comes to these things. And especially with REITs, it is key. So they've been doing well in the markets. I'm really curious to see if they continue, how the price appreciation goes for this one. But let's check out the dividend history. Like I said, they did cut their dividend just about a year ago on the 27th of September from $1.05 to 86 cents. Still a really solid dividend. They're still at 5.5%, 5.6%. And now let me explain this to you. If you aren't familiar with dividend investors, they are some stubborn people, myself being one of them. Oh, they have special dividends every once in a while too. But when you look at this track record of dividend, they've been growing it like mad. From 2010, it was 50 cents. 2015, 95 cents. 2020, $1.04. And then all the way up to 2023, before they cut it, it was at $1.07. So they were seeing continual growth, and that is what a lot of people want to see with their dividends. Because if price appreciation isn't phenomenal, like we saw with WPC, but the dividend growth is good, they can counteract each other and you can still make a good amount of money. And so with the CAGR, which is the compound annual growth rate, which we can jump into the growth sector or the growth area, we can see they get an F because they cut their dividend. And so thus growth was negative. But had they not cut the dividend, they were continuing to grow it at some pretty decent rates. And so that's why dividend investors got really upset. This was a company that kind of boasted that it would never cut its dividend, but in the end it did. And even if that was for the better, it still really hurts the user. It hurts the people that own the fund, that own the stock. Payout ratio is low at 73%, which is great for REITs. And then the dividend yield 5.59%. And you're getting $3.48 every single year in dividends, and it does pay quarterly. So WPC, I think the growth with this one over the next few years will do well. I'm probably going to hold this for 5 years, if not more. And if they can keep the dividend growth going back and even passing what the dividend used to be before they had to do the spinoff, I would be pumped. But that would take some time. And you have to have some faith and believe that they're not going to cut the dividend again, which is still pretty risky. So I hope you guys have enjoyed this first one. Let's jump into our next one, BSR, a phenomenal REIT. This is definitely the riskiest of all of the REITs I'm talking about today. We are looking at ticker BSRTF, an OTC REIT. Now, if this one has potential to be put on one of the exchanges, it would do extremely well and get a bunch more eyes and potentially some better investors like institutional investors. But for me, I love this thing. It's got a decent dividend yield. I think it's a little bit over 5%, but we'll double check that. And we can see it's trading at $14 currently. Over the last couple of years, it's only been trading since 2018. It's still seen a 47% return. Now, in the last month, like I said, REITs are going insane. This thing is already up 20% in the last 6 months on one rate cut. If they have 3 or 4 more and this thing continues to profit off of that, it could be phenomenal. So I love BSR. I know that it is higher risk and you may not have even considered purchasing an OTC REIT, but there are some really good ones out there. And there's a few reasons why I absolutely love this REIT. I have a full video on it that I'll link at the end if you want to check out BSR. I have already done a deep dive into it, but not a lot of people know about this REIT, so it didn't get a lot of traction. But I think there's so much potential for this REIT, and let me tell you why. So BSR is very, very interesting. They own a bunch of properties, apartment complexes, living areas, all in the Sun Belt. primarily Texas. We'll take a look exactly at the geography and where they own things, but these are beautiful properties. And so there's two reasons when I first did the video on BSR that I talked about. One was the rate cut, and two, companies are leaving California. We have seen Elon Musk remove the Tesla facilities as well as the SpaceX facilities from California. Companies like, what was the last one? Chevron. Chevron has been in California since 1890, and they are now deciding to move their headquarters, and guess where to? Texas and the Sun Belt area. It is cheaper to work there. It is cheaper to live there. Things are just better. And that's coming from someone that lives in California. So, I mean, these are stunning properties. And the thing that I love with these are not properties that are for, they're not targeting middle class. They want people that have money. This is stunning. This is beautiful. And it's going to be cheaper than areas similar to this in California, in New York, in more expensive states. So they are internally managed, which is phenomenal. For those of you that don't know, when it comes to REITs and BDCs, internally managed saves you a lot of money. It can be riskier. You need to have a really good team if you are internally managed, but externally managed costs more money because you're paying someone else to do the job. So we can see Texas, they have 25 properties, 7,600 units, 4 properties in Oklahoma and 3 properties in Arkansas. Some pretty insane numbers there. I know when it comes to the Texas properties, they have a ton in the big cities, Houston, Austin, and stuff of that sort. So look at these facilities, look at these properties. They are beautiful. They are not low income areas. They are not low income properties. And so I really, really think that there's some really high percentage of people that want to, not only that are going to be moving there for the work based off of working at Tesla, working at SpaceX, working at Chevron. You're going to have an influx of people moving. They have higher immigration. And so I think there's a lot of potential for this fund to do well in the next 10 to 15 years. That's probably how long I'll be holding it for. It is just insane. Let's take a look at the dividend. One thing with BSR is they are not dividend focused, I would say. They do have a 4.09% dividend yield, which is good. But the dividend growth has been a little bit all over the place. I think they're getting into a position now where they can focus a lot more on the dividends, but growth has not been their main priority. And we've seen this. They do pay monthly, which I love. And so when you're looking at this one, this is more so one that you would look for price appreciation rather than dividend growth. I mean, they didn't grow their dividend at all in 2023, and they barely grew it in 2022, but we have seen a recent growth bit in 2024, which I like. They may start prioritizing that a little bit more, but price appreciation wise, if we go to the 5-year, this thing at peak it's down 35, 36%. A lot of these REITs are beaten down because of interest rates. So it is important to know what you're looking for and what you want from these REITs. Now let's check out the drip calculator, see how this one has been performing. I just scared myself, so I always type in BSR. I forget it's an OTC stock, and BSR has had a terrible return. I was like, why am I doing a video on this? I've already looked this up. I thought I had it. BSR TF is our fund. So we can see that since 2021, it has performed well. Total return of 40%, which we already saw. Average total annual return of 9.4%. Roughly what the S&P 500 has returned, maybe a little bit under, but still pretty phenomenal. And we have seen this crazy drop because of the rates. So with rates going down, I think that this one has some insane potential. If they can get some dividend growth and get some investors that are dividend focused, it could do really, really well. Reinvesting dividends has performed a little bit better, about 2% better, but overall it's pretty close. So let me know what you guys think. Is this one too risky because it's an OTC? I'm really, really curious to see what everyone thinks. And this next fund is one that I bet you haven't heard of. It is super, super interesting, and I bet it's different than any REIT that you own. Ticker ARE, Alexandria Real Estate Equities Incorporated. We can see this one is down over the last 6 months, but only 0.5%. If we jump to the 1 year, it is up 12.3%. 5 years, down 17.9%. And max, up 465%. Also trading since 1997, which was a good year. That's the year I was born. And so we have seen with ARE, this drop has been insane. This is one, interest rates, post-pandemic world, it is down $98 a share, which is 44%, and hasn't jumped as much as the other ones with the rate cuts coming through, which I think is a crazy, crazy amount of potential for this one. Now, market cap, $21.8 billion, pretty good. Let's take a look. This is a different type of REIT that I bet you haven't traded before. So ARE, they are in the business of science, of life sciences. They have labs, they have large buildings that are customized for laboratory work. And it's really, really interesting. The data they have on their website is phenomenal, really beautiful presentation. But it's super, super interesting. All this data, I have a science background myself, so I know that these buildings are specialized. Not anyone can rent these, which can make it difficult. But there are some pros to that as well, because if you are a company that needs one of these buildings, you are not likely to move. There's not nearly as many options for you to move to, and especially when it comes to being at one place for a long time, these businesses, they stick to what they know and they stick to where they are. So what's interesting is they have had the best return out of all of these funds, right behind Welltower, which is just about 2,000%, about 500% return more, but Welltower has a lower dividend. So I'm not sure if this is with dividends reinvested or not. But one thing with the more recent stuff, their last 5 years, they have the highest FFO per share multiple, which is great. And Welltower, I might have to do a video on Welltower because that one's pretty phenomenal as well. Ticker WELL. So we can see there's a ton of stuff on here with what they're doing, what they're focusing on, and the financials. And I recommend looking at all of it because it is really, really important stuff. Increased line of credit by $5 billion. This is going to be phenomenal when rates go down because of the fact that they're going to pay less to borrow that $5 billion, although they don't necessarily have to borrow $5 billion. We can see the growth in net operating income, which you always like to see. 2023 was the best so far, and I'm speculating that they are going to continue to increase that. This is from 2023. We'll see the 2024 report when the end of the year comes around. But there's tons of stuff on here. Check out the awards that they've gotten. I think that funds like this that can give you some diversification are phenomenal. I don't own another REIT like this. I own medical ones like hospitals and whatnot, but this one is very, very different. You can check it out, put all the details in. My cat's even joining me for the video, and let me know what you guys think. Let's jump into the dividend history. So, I mean, the stock is beaten down, but the dividend continues to grow. It is absolutely phenomenal. They do pay quarterly, a little bit of a bummer. I'd love a monthly payer, but we've seen since 2010 from 35 cents a quarter all the way up to current $1.30 a quarter in 14 years. That is some insane growth, and we can actually check out the growth on Seeking Alpha. They have a B+ in growth. The compound annual growth rate has been 3% or 5% for the last 3 years, 5.6% the last 5 years, and 10%, 6.2%, which is absolutely phenomenal with really good revenue growth as well. So lots of bonuses to this. It's not an A, but that's still some pretty good growth. This one might be the best growth pick on here. A dividend yield of 4.27% and an annual payout of $5.20 a share. With a low payout ratio, if you're looking for security, payout ratios being lower is phenomenal. 55% payout ratio is out of this world. I can't even believe that. That's absolutely great. So there are definitely some bonuses to this fund, and it's definitely different, this REIT, than the other two that we've been looking at. Consecutive years of dividend growth is what? 13, and they have 26 years of consecutive dividend payments. So they're 1,000% different to the sector and 200% based off of consecutive dividend payments, which I think is phenomenal. They've been growing, they've been doing well, and it looks like based off the balance sheet, they're going to be able to do that for a very, very long time. So yeah, kudos to them. I'm pumped. Let's throw it in a drip calculator and see the returns. Through ARE in, we can see that the total return is 929% with dividends reinvested, only 544% with dividends not reinvested. And that bites into what I was talking about. When you have a company that's kind of newer, like BSR, if you're buying and reinvesting the dividend early on, it'll make a huge difference if that company can do what ARE has done and grow for 26 years. So pretty phenomenal. Your average, let's see the yearly return. Oh man, this is just insane. The dividends reinvested per share is $76.13. Absolutely crazy. Annual total return is 9%, around the same as what we've seen with some of the other funds, but still absolutely phenomenal. With dividends not reinvested, that goes down to 7% average annual return, and just the return goes insane. So starting with 10K, you would end with $102,000, almost $103,000. With dividends not reinvested, your 10K becomes $64,000. Still a decent return, but not as good as some of the other funds that we've seen, like the S&P 500. So I hope you guys have enjoyed this look into these three REITs, why I like them, why I'm buying them. Let me know what you guys think. If there's different REITs that you are buying, let me know, and especially what you think about with these rate cuts. What's going to go crazy? Is the market already pricing all of these in? I'm super, super curious to see. So I appreciate you guys for watching. If you stuck to the end, you guys are the best. Check out some of the other videos I've linked at the end, and I hope to see you in the next video.